I think it's very ambitious of me to try and in a half an hour session to convey to you all the lessons which one could have learned from the recent stock market crash. And I'm telling you there are many. We try to take one or two of them, and probably the more important one, and see how we can benefit from it at the end of it. What broadly we're going to do is run through a couple of slides which are just graphical. So they will convey the point I'm trying to make, and ultimately drive home the point that investing goes much beyond stock markets. Investing has got a lot more to do than with just timing your investment. And investment ultimately should be driven by what we call asset allocation, and what we find that not many investors do. So we'll go through this quickly and then we'll try to take a couple of questions. BSE Sensex for the last 8.5 years. Why 8.5? We took the period starting 1st of January 98. Most of you are aware that we had what was called the TMT boom or the ICE boom in India and across the world starting around 99. So to avoid the distortion, we went a year back and took the data, and just look at what you have. Between at the start of 99 and by March 2000, in a period of 14-15 months, the stock market has doubled. In the subsequent 3 years, the stock market has fallen by half. And in the 3 years after that, you've seen the markets go up by 4 times, 300%. This is a complete stock market cycle. What most of us read today, what most of us are witnessing today, what most of us think about when they're investing is just 3 years old. When we think about stock markets only go up and we're looking at timing the market and we're doing all sorts of things. If you look 8.5 years back, 97 is when the Indian economy in its initial cycle had peaked. If you look at results of companies like Tata Motors, Tata Steel, you'll find the industrial companies, you'll find that March 97 results were their peak before they all went into a downhill. This is a complete stock market cycle, and we can tell you with all conviction that these cycles don't end. There will be a cycle. Tomorrow you will have a bear market. We tell our clients all the time when we are planning for their retirement or for the child's future that we are planning 10 years from now. Our assumptions are 12 to 15% for an aggressive investor, but that does not mean there will not be a bear market. The question is basically that given what is happening in India today in terms of the outsourcing and the activity, it seems possible that the Indian stock market could rise perpetually and we could touch 25,000 in the next couple of years, and the cycle may not happen. That may be a possibility, but how we look at it is that the stock market is a function of two things. One is, of course, the fundamentals, which we look at a lot. And the other is sentiment. Infosys was always a great company. There was no reason for it. If you look at that, there was no reason for it to fall ever the way it did. The perception of the people changes. The sentiment towards stocks changes. So you have something called a price to earnings multiple. You have a company earning 100 rupees. At one day it could trade at 110. The other day it could trade at 90 rupees. And that's what induces cycles. Cycles need not necessarily in India be driven by domestic environment. It could happen because of US interest rates rising. So I don't think any one of us should ever factor in a situation where cycles will stop happening. And in any case, you should look at an allocation. You should diversify your portfolio in different asset classes. Don't just look at stocks. You really don't know how it could turn.